welcome for you that are joining us live, and then also those of you that are watching this on recording. This is our regular series that we started a few months ago, providing a market and a portfolio update. It's an evolutionary process, so we've been taking the feedback that we've gotten from some of you on the call now, and then also other investors. Keep it coming. We're always trying to make this as valuable as possible. The one really good piece of feedback that we've been getting is communication is paramount, especially in times like we have right now. So appreciate that. For this month, we're going to focus a little bit more high level market and kind of drill down a bit. It's going to be less down to the nitty gritty, finer details of each property, because quite honestly, month over month self-storage is not that interesting, which is a wonderful reason why we're in it. So we're going to, when we get down to the property level, it's going to be more broad strokes, more significant, achievements or milestones or messages related to property. And then on a quarterly basis, which will be next month, we will give more finer granularity. As always, if you have any specific questions, the opportunity to ask is now, or obviously at any time. So let's jump in. So we've got a few things going on out in the market. Obviously, you guys are a little bit more, a lot more sophisticated than the average person watching the news and markets, know what's going on. Just watching the headlines now, and we'll talk about this in a minute, is the Fed raised interest rates quarter point. Headwinds are still blowing. In fact, the headwinds are maybe some crosswinds that we're seeing right now. Some of the major headlines, obviously, of recent weeks is the Silicon Valley Bank, Signature Bank, as well as drawing a blank. No. Drawing a blank on the third one. Anyway, the U.S. banks, Credit Suisse, that also had a collapse and acquisition over the weekend. Maybe not. I hear some things may be changing on that front as well. Actually, I have my notes right here, so sorry about that. So Silvergate was the other one. So what we're looking for is primarily is what are the broader markets doing and how does it impact us, right? So first, can you go to the next slide? Okay. So from a broader market perspective, the Fed just announced they raised interest rates a quarter point. That was pretty much baked into the forecasts, strictly because if the Fed, didn't raise rates, then it might suggest to the broader markets that there's a little bit more banking chaos than, and a little bit more reason to be panicked and alarmed versus doing what they said they were going to do, which is raise quarter basis points. That's probably the consensus. About 80–90% of the economists and folks out there was waiting to hear what the commentary was post the meeting to understand what the direction is going to be. And I just saw a headline. I was trying to watch the press conference, but as usual, they didn't start on time. So what we anticipate now is likely, and this is my best guess right now, is that they're going to kind of walk back a little bit more of the aggressive stance on interest rates. They did indicate that interest rates or inflation is still a little bit stubborn, but the banking world chaos that's happened has kind of changed a little bit of their stance. We've actually gone from quantitative tightening to, depending on who you're listening or what you're reading, to a little bit more quantitative easing again. So I would expect that the next meeting, you're either going to see no increase at all, or if there's a little bit more turmoil in the markets, that you may actually see an emergency meeting come up where they cut rates. I don't think that that's likely, but it's something to watch out for. That's what we're looking out for. The balance sheet of the Fed now is at 8.6 trillion. Last month is 8.34. So that's where we say it's going from quantitative tightening to quantitative easing, even though they're not calling it that. So 10-year Treasury is at 3.5%. Actually, that is moving rapidly. I think since I was looking at it a couple hours ago, it has dropped like 4%. We care about that because that's where what we measure primarily, or banks measure interest rates on debt. So right now we're looking at probably somewhere between 6.5%, 7% interest rates from lender perspective. As I mentioned, the key message from Jerome Powell is we don't know yet. We'll figure that out. From an overall financial markets perspective, SVB, Signature, and Silvergate collapses were each unique, but not unique in the proximity that they happen to one another. Obviously, and a lot of this comes down to just terrible risk management. And I want to talk a little bit about risk management from a overall investment standpoint, and as it relates to what we do, and just kind of some warnings or some cautions that you might want to be aware of regarding, your existing portfolios or just the markets in general. It's been interesting, hearing and talking to some of our lenders and some of the folks that I know that have been in banking for a very long time, and just getting different perspectives. The overall message is that the too big to fail banks, and primarily consisting of probably the top 5 banks, nationally, JP Morgan, Bank of America, Wells Fargo, and those likes they're the ones that will absorb assets and, backstop a lot of these banks if there is a big failure that continues to snowball. Some of the banks like First Republic and Ally Financial are kind of on the watch list now. They're the banks that are making a lot of headlines just because of the size of their balance sheets and assets, and the value of their unrealized losses on their balance sheets. Now, I'm not going to get into a whole lot of conversation around balance sheets and all of that, other than it's worth keeping an eye on the overall markets and the banking sector to see if there's any kind of contagion related. From our perspective, we were out. Hopefully you all get our emails. If you don't, reach out, because it might mean that we're getting dumped into spam. But we were pretty active over the weekend once we started to hear the banking collapse. And, a lot of this comes down to our team being veteran and what we call crisis hardened team. Working at the Fed for 20 years, I was got firsthand exposure to the response and reaction to banking turmoil. So we basically just applied the same thing. And what we did was went out to all of our lenders and asked them if they have exposure, if any of their relationship have exposure, and pretty much anybody that touches any funds that we have. And the only thing that, and we didn't learn that there was any risk. So we're pretty happy about that. And I personally talked to most of our bankers to just get a feel for where they're at. And they're pretty much, in the clear for all this. Fractional reserve banking is an issue that can be a source of contagion no matter what. And what that basically means, if you're not familiar, is that banks obviously don't maintain one-to-one assets for what they have on their books relative to deposits. So any bank that were to get a run on the bank is likely going to fail because they just don't have a dollar for dollar coverage related to their deposits. What I did learn is about an ICS program, and this is a interbank sweep for insurance. And what that basically means is there are about 3,000 banks that participate in this. And for any account that is over the $250,000 limit for FDIC insurance, it's an extra layer of insurance. So we're actually looking at our property accounts and enabling this for any of our accounts that are over that threshold, just to be extra cautious. I'm bringing this up primarily to want to highlight what we're doing, but also if you are invested in other real estate or just in general, and you have, accounts that are over that threshold, to inquire about it. Most institutions require you to request it, and then they will enable that. In our case, I think is like a couple $100 per account per month. So it's just worth having that extra protection on accounts. And then the last thing I have here is just contacting financial institution investment advisors to understand any exposure. We know that, like, an example is with the Credit Suisse mess, is the Swiss National Pension Fund had huge exposure to Credit Suisse. So the pension funds there lost something like $700 or $800 million in that pension fund. Now, I'm just highlighting this as more or less that there are downstream and there's a ripple effect to a lot of these things, not to alarm anybody, but just something to keep in mind. If you have any accounts or anything that you want to just sleep a little better at night, it's worth reaching out to anybody that handles any of your financial, your assets, to just get a handle on that. Last thing I want to mention on that is the one thing that was surprising, the bit of feedback that we got when we sent out our communications was how many other, a lot of our investors are invested with a lot of other sponsors in other real estate deals and other passive investment products, that they haven't heard from their sponsors. And that's unfortunate, because communication and transparency is key. You shouldn't have to reach out to sponsors to understand the health of their business, the health of your assets, the health of your investments. So if you haven't heard from, if you're in other deals and you haven't heard from those, just reach out. That's all I'll say on that matter. We do understand that there is some distress that's surfacing in the broader real estate market and commercial loans and commercial investments, just from some floating rate interests on business plans that haven't been executed that are now coming due. Things like interest rate locks are expiring, and the cost to interest rate caps are expiring, and the cost to keep them going are a little bit expensive. Let me stop there and see if there's any questions on that before we jump into just going into self-storage. All good? Okay. If there is, just, you could throw them in the chat and we'll address them as we go. All right. So overall self-storage market. So I'm going to talk about this, and then I'm going to throw it over, talk about a little bit on our properties to Mike, and then we're going to talk about our current strategy and intro for the rest of the way here, and then we'll kind of wrap it up, and if there are other questions. The Big Five annual report. So in a broader self-storage market, so we look at the REITs are obviously publicly traded, so we can glean a lot of information on how their performance is and then measure that up to how we've done with our portfolio in our assets. A couple of noteworthy things here is, one is self-storage post-COVID, end of 2020, all of into 21 and 22 were banner years, right, for self-storage. They were the years that we've had tremendous growth in terms of revenue, NOI, occupancy, so on and so forth. So that we know that train was going to slow down. The same store NOI from the REITs grew from an average, or from a range of 9.4% all the way up to 13.4%. We will have our performance measured against that for our quarterly update next month. And then occupancy was slightly down from to about 90 to 94%. Bearing in mind that when we underwrite our properties, we're typically looking at a 90 to 92% physical occupancy as being stable. So that's a normal year. 22, going into 22, we saw the highest occupancy numbers pretty much ever, which were typically, 92, 90, all the way up to 95%. Interesting to note is overall operating costs increased by an average of 3%, which is, it's worth highlighting there because, we hear about inflation at, above 6%, 7%, 8%. but the operating costs for self-storage are not moving at the same pace, just because we are not, there's, quite honestly, there's not that many expenses, right? There's insurance, the static expenses are insurance, property taxes, those kind of things, and they typically don't move in line as much with insurance, although insurance with inflation, although insurance has spiked a little bit. But overall, expenses have not grown at the same rate as national inflation, which is fantastic. I've been speaking to several brokers to get a good feel for where the market is in general for acquisitions and where properties are. And what we're starting to see is, or what the brokers are starting to see, is that sellers that recognize now that they missed the peak period to sell properties are kind of like kicking themselves and thinking there might still be the tail end of that. Some brokers are still looking to list and sell properties based on pro formas or trailing, 1 to 3 months annualized, that kind of thing. But we're starting to see an adjustment in property prices, which bodes well for just normalizing the overall market for acquisitions. One of the things that was highlighted is that cap rates, they're starting to list them based on 6.5% cap rates based on in-place income and expenses, which is great, because historically, over the last few years, there's been a lot of stuff that come onto the market priced based on pro forma numbers, which doesn't make a whole lot of sense. Overall expectations going forward is we think there's going to be more distressed properties where there's some debt repositioning required. They're going to bring some properties to markets. We're hoping that our buying power and our diligence is going to surface some good investment opportunities. So we like to tell our investors, keep your dry powder ready. Not to mention consider the income portfolio, which we still have open. And then occupancy and rate increases are normalizing more, going back to where they were normally, and not necessarily the heightened levels that they were. Mike, anything that you want to add on that, or do you want to touch on some of our portfolio?
Yeah, no, I think your commentary was excellent, actually. Great coverage of the current issues. I would say with our portfolio, as you're seeing on your screens, the bullets reflect, there's been no impact from the current banking chaos. That's pretty much par for the course in storage. It's one of the great attributes of the asset class is its resiliency. Been in this asset class through multiple recessions, and great and small, and it continues to be resilient through all of them. Thanks, Corinne. Yeah, perfect. Right there. That's the Federal Reserve Pricing Index. Blue line is pricing power of storage operators across the country. Gray bars are recessionary periods. I think we glanced at this briefly last month as well. So it's just a great reason to be in the asset class. We expect there to be no difference in performance through what we expect in recessions a little bit earlier. Particularly looking at our rates are so first matures in 2026. So during the portfolio, we have had excellent demand of seeing in January fluid action, and I can tell everybody that calls stores are physically and digitally more ready to capture business than they were in January. The fresh they'll focus on how to get customers off the street or off their laptop and into our store facility. We've looking at it this afternoon on our performance metrics. We're plus 9 net rentals, which is great for our portfolio. Nice to see that activity. We and something kind of exciting to share with the group, all the other initiatives I mentioned in the realm for our stores. So we sat down in February and started talking about what we were doing digitally. Nothing exciting. Storage Pod was doing a little bit of advertising for us, and using all the usual tools to advertise digitally and reach more customers. We decided to make some changes. We engaged with their name. They're going to be able to more effectively market every one of our stores, really push click-through rates, unique visitors to websites, get more business onto our web pages, get our web page in front of more customers. The net result is more rentals. And they're going to do it for, they're pricing it right now at about $400 per month per store, which is a fraction of what it cost kind of in the peak days when Google had the market cornered. So we're pretty excited about what Automate can do. It's going to take them a little while to ramp up. It's a learning-based algorithm. So that takes a little time to fine tune, but once it gets cranking, we think we're going to see some healthy activity this spring and summer.
Thank you, Michael. Something else to talk about when it comes to our existing properties is, from an overall distribution standpoint, we're coming to the end of the first quarter. And, other than seasonality, we're hearing from some other operators that they're pausing distributions because of the chaos in the markets, and don't necessarily understand why. It's probably more related to the actual property than the actual market, although they're, it's probably related to interest rate risk. But ours is business as usual. We expect that there's, between third and fourth quarter, there's going to be, there's the expected seasonality of performance, but otherwise distributions are going to continue based on overall property performance, which is overall trending where we need it to be, and where it's not, we're making the adjustments, which Mike highlighted. Otherwise, continue to evaluate things. One of the other this Monday, super excited about that. Past life at Extra Space and Store Space. He comes to us with a great wealth of experience, both at REIT and private firms. One of the initial tasks that Henry is going to be engaged in is evaluating, underwriting, looking at our entire portfolio, participating in the asset management program, making sure that, our forecasts and our projections are, in line with where they should be, and recast wherever is necessary. So that's super exciting. Henry is also coming into us where some other operators are not necessarily overall talent out there to bring some great talent, which is what we are doing. We are improving our talent. We are priming our plan for the other side of this little dip in the economic cycle. And as part of that, it's about being patient, which we have been patient when it comes to acquisitions. There are going to be deals we have a pipeline of 5 properties that are on contract right now. They will be already development deals, so that's where we're seeing some yield there. Our overall strategy is going to be to continue to underwrite conservatively. We've always done it. Now, a matter of continuing to tighten those dials, maybe add a little bit more buffer where necessary. We're underwriting more rather than analyzed recent trends, which has been something that you could do when the market was growing more rapidly. And then also we're using just more normal, steady market rates for market metrics for rate increases and occupancy, using trended numbers, meaning that we're not looking at it at a point in time underwriting. Do that, and our data is conservative, which is over 300 basis points, and then also lower loan to value and loan to cost, being super conservative. So that's our overall strategy right now. We're now seeing that proved out. We are, steady goes, and then and that's pretty much it.